in some sense, Vinod Khosla talks about this idea that in the future, doctors will be actors, these robots will be doing all the surgeries. It's the same way with advisors, right? Great financial advisors will be great actors, and they'll be great at bedside manner and great at understanding how clients think and how to kind of manage those relationships and translate that into things that technology and problems technology can solve effectively.
Does that change the sort of expertise that an advisor actually needs to be a good advisor?
Yes. I think that it means that advisors have to lean in more into, we're going to provide great relationships and we are going to understand what makes our clients tick and how do we become a more core part of their holistic life and everything about them than just thinking about the sliver of the portfolio that they manage today.
You could almost imagine a world where you don't have to study finance to become a financial advisor.
The best financial advisors will probably study psychology, or they'll be the highest EQ people, not IQ people.
Welcome to the Capital Connect podcast. My name is Ben Haber, and I'm the co-founder and CEO of Monark Markets, an API infrastructure connecting brokerages, custodians, and wealth management platforms to private markets. On Capital Connect, we take a deep dive into the most interesting and timely topics in private capital markets with the most informed and intelligent guests in the ecosystem. Each episode is a discussion with our guests based around 3 core questions that are shared in advance. Today, I'm joined by Samir Vasavada, the co-founder and CEO of Vise. Vise's vision is to create the asset manager of the future, enabling personalized portfolios across all asset classes, entirely driven by technology. Samir has raised $125 million in venture funding for Vise, which is backed by Sequoia Capital, Ribbit, and Founders Fund. Samir, thank you for being here.
Thank you so much for having me.
Absolutely.
Awesome to be on the podcast.
Love to start with a brief background on your founding story for Vise, how you came up with the idea, and how it's been going so far.
Yeah, so we started the company about 10 years ago, which feels like now a long time. And originally the thesis was, if you had asked any investor in Silicon Valley, what does the future of wealth management look like? They'd say you get advice from an app on your phone. And our belief was that wasn't going to be the case, because as investors got wealthier and wealthier and wealthier, they wanted a human to talk to about their money. So we knew that financial advisors and the human relationship would continue to exist. The issue was most human financial advisors couldn't really provide the advice that their clients were looking for. They had to make a trade-off. Do I deliver a deeply personalized portfolio of, private assets, tax-aware investments across a handful of ultra-high net worth clients, or do I run a scalable wealth management business and provide all my clients a one-size-fits-all portfolio and manage a lot of mass affluent clients? Our belief was they shouldn't have to make the trade-off. Advisors should have one platform that can understand all their clients' investment needs, recommend a multi-asset class portfolio personalized to their needs, best suited for them to hit their life's dreams and goals across all client types, whether it's an ultra-high net worth client or a mass affluent client, enabling them to focus on what they do best, which is their client-to-client relationship. So if we look back, though, to where we started, it was originally out of this idea that AI was going to have an impact in every single major industry. In the industry we saw it having the biggest impact was actually in wealth management and financial advice. We were probably just 8 years too early to the trend.
And so maybe just talk us through what Vise looks like today as a platform, what your core competency and capabilities are.
For sure. So Vise services 2 kind of core market segments. Core RIAs, you can think about that as your kind of mom and pop shop breakaway firm that probably left being a advisor at UBS or Merrill Lynch or Morgan Stanley and said, I'm going to start my own RIA. And we are like their end-to-end operating system. We help them with reporting. We help them build their portfolios and understand their clients' needs. We help them generate proposals. We help them do all of these things that different point solutions used to do, all in one fully integrated experience. And the benefit is it can bring down the costs for them. It can increase the scalability of their firm. So advisors spend less time in technology and more time building, recommending, and talking about portfolios. And it delivers a client kind of a better investment outcome, because we believe that by doing everything with technology, we can understand clients' needs better, make better investment recommendations that are more tax aware, that help them kind of save money on taxes, that help them better understand their risk tolerance and their goals, which best suits them to kind of retire. Then we focus on the enterprise RIA channel. So this is kind of the core market, which is RIAs that are growing through M&A. They've got private equity backing. They either recruit advisors. They acquire smaller firms, those mom and pop shop firms, and they grow to being these kind of compound RIAs or these large wealth businesses made up of lots of smaller wealth businesses. And our primary objective is we're both their software platform, but we're also their kind of integration and transition layer, meaning when they buy those firms, we integrate and transition those newly acquired firms into their, new centralized platform. And then we run that centralized platform. So all their trading, all their rebalancing, all their order management, everything all in one fully integrated platform. So it enables these large wealth firms to have a huge amount of scale. And the belief is as these firms do more and more M&A, they're going to become bigger and bigger and bigger, and we'll have bigger and bigger growth as a result.
Super interesting. I want to get into our three questions, but before I do, I think the trend of private equity backing a lot of these sort of RIA roll-up firms is something I've been super interested in. You mentioned the process of actually supporting these acquired RIA firms as they consolidate into a single tech stack. What does that actually look like in practice? Do you have like forward deployed engineers that are working with these acquired firms to unify their tech stack? Or, I'm sure that's a fairly messy process. So I'm just kind of curious what that looks like.
So we don't fully unify their tech stack in the sense that, they probably have a CRM like a Salesforce, or before they were on Wealthbox and they want to transition to Salesforce. That's up for the firm to figure out, and we provide a lot of great advice, but we do anything that touches the money. So if a client comes and they've got, they've acquired a small RIA, and that RIA is invested in a hodgepodge of different investment managers, hodgepodge of different strategies, and that firm now says, okay, well, you have a trader, you have a rebalancing solution, you've got a tax management solution, you've got all of this investment scaffolding and infrastructure that holds up the way in which you invest. We want to transition that out of the way you invest into the way we invest. So we want to transition you to what they usually refer to as centralized models. We help handle that entire process. So how do we understand all the investments they're in today? How do we map out the tax consequences to transitioning them? How do we map out all their managers that they're in today to direct indexes or proprietary managers on their platform? And then actually handle all the trading and the rebalancing. So historically, you'd have a whole team of people. You'd have traders, you'd have a portfolio consultant, you'd have dozens, if not sometimes even hundreds of people that go into all these RIAs, map out the portfolios, transition them over, try to understand the tax consequences, and then operate the software in order to do that transition. And then post-Vise, it's entirely automated. You don't need any people. And what this does for the enterprise is it either enables them to repurpose those people to generate revenue, or they can remove those people. And by removing those people, they can increase cost synergies, and they trade at pretty high EBITDA multiples. So every dollar they take out of cost is, call it like $20 to $25 of enterprise value. So if they've got $10 million of investment cost, that could be $250 million of enterprise value they create, their Vise helps them create. As a byproduct of this, not only do we help them create more cost synergies, but we actually help them speed up the time in which it takes to integrate these firms, so they can go do more deals and they can acquire more firms and integrate them much faster. So that's primarily the biggest kind of area of transition, but it's also the biggest area of cost and time spent when they acquire these firms.
Super cool. And that makes a ton of sense. So I'm curious your point of view on the future of the RIA channel and wealth management in general. What do you think changes 10 years from now? And what's sort of the roadmap from here to then in terms of technology, personalization, the role of the advisor? What does wealth management look like 10 years from today?
So I think the industry as is pretty screwed. And the reason why is it's not because AI is going to replace advisors. It's going to be because there's AI that enables a certain subset of advisors. So if you look at advisors that leverage technology, that run efficiently, that are kind of leaning into a tech-forward approach, that are focusing on kind of younger clients, where you're going to get a longer lifespan out of those clients and the client relationship, tech-oriented clients. There's a lot of really great kind of firms that are seeing success in that segment that will win the market because they're able to use all of these things and then deliver more services at a lower cost. And the reality is a lot of these other firms are run by, relatively older management teams where they're serving older clients. And the reality is a lot of those kids that inherit the money from those older clients will fire those older advisors. And those older advisors primarily help with financial planning, estate planning, and, basic investment management. And they're going to be competing with a subset of firms that offer all of that, lifestyle services, bill pay, tax, all in one integrated experience at a third the cost of those traditional advisors. So there's going to be advisors that make it and advisors that don't make it. And the advisors that don't make it will have it, come at them much faster than I think they realize over the last 10 years, because the diffusion rate of technology is so much quicker than it used to be in a pre-AI world.
I think I broadly agree with that thesis, but it feels to me like part of it is predicated on the idea that this sort of great wealth transfer from the older folks to the younger folks will happen relatively quickly. Do you see that happening today? Has it started? Are we in the midst of it already?
So I think that the 40s, 50s-year-old client, which still does have a traditional advisor, is where most of the money's kind of flowing to. It's not your, Coinbase Robinhood user that's in their late 20s. And I think the wealth transfer is going to that like 40, 50, 60-year-old, not necessarily that 20, 30, maybe 40-year-old. And those people have a dramatically different view. They still see financial advisors as being very important than your kind of millennial or Gen Z client. That being said, the key difference between now and 10 years ago was, because of Claude and ChatGPT, a 40 or 50-year-old doesn't need to be all that sophisticated. They can upload their portfolio to Claude or ChatGPT and say, hey, how is my advisor screwing me over? And a lot of them will do it. It's not that hard. It's pretty easy. Most people will do it. And the reality is, it doesn't take much for Claude and ChatGPT to say, oh, you're in a whole bunch of active mutual funds. Those active mutual funds have huge cost. Also, you're paying your advisor 125 basis points. That doesn't make all that much sense. And it's just little things that most people haven't really picked up on, but these LLMs will start to expose. And then what's going to start to happen is more tech-enabled advisors are going to have tooling and technology that will demonstrate, upload your portfolio here, and we'll show you the difference between us and your advisor today, and what the compounded difference is on fees, what the compounded difference is on tax. And there's going to be more and more of these tools that start to show up, and those tools will be readily accessible to, many, 40, 50, 60-year-old clients. Will be extremely easy for them to use and realize, okay, I'm getting screwed over by my advisor. Maybe I should look elsewhere. And when people see how much these advisors cost them over 10 years, 20 years, they will start to switch.
So one of my questions was actually about how financial advisors today should be proactively reaching out to the younger generation. But before I go there, I guess I'm curious. It sounds like your point of view is maybe right now they don't need to be going all the way to the 20 or 30 or even 40-year-olds, because most of the wealth is still in the 40 to 65-year-old segment. Is that your point of view? Or
if I was an advisor today, I would focus on the 50-year-old segment. I would figure out how to offer more services. So how do I go buy an accountant? How do I go buy a CPA firm? How do I offer lifestyle services? How do I find more things, more ways to differentiate myself than just, I'm your advisor and I help with estate planning and tax and I meet with you once a quarter? That you can provide on an ongoing, recurring basis to show that you were indispensable to your clients' lives. Then once I do that, I'll start hiring younger advisors that can go after different segments of the market that are really hungry, because the challenge with a lot of older advisors is they see their book as more of an annuity. I've got this book, I built it over a bunch of close relationships over the last 20 years, and I'm just going to sit on it and let it pay out, as opposed to I'm going to go get that incremental new client, a new client, a new client. So it's a long way of saying advisors have gotten really lazy. So I find people that will kind of encourage me to be more aggressive in my growth journey. How do I try new things to drive organic growth? How do I really push forward in terms of growing the way I can to really maximize my value? Then I would try to understand, okay, how do I make my cost, more competitive? So maybe I charge the same cost, but I give more services, but then I have a whittled down version that I deliver at a much lower cost, that I can show that I'm more competitive and win new clients. So if I can drive organic growth, if I can offer more services, if I can hire younger advisors and go after slightly younger clients, I can build a really great business over some reasonable period of time.
so as all of these services become more automated, as AI plays a larger and larger role in the actual practice of wealth management, what does the human advisor do? What becomes their main function from your point of view in the client relationship?
So today you've got a human advisor, you've got a whole back office team. So you've got traders, you've got a chief investment officer, you've got investment support specialists, you've got portfolio consultants, you've got all kinds of different ops people. And then those people sit on top of a whole bunch of tech. The way it's going to look like in the future is you might have one or two ops people that help stitch together all the tech and the brand and everything else, but it's really just the advisor plus software. So you can almost think about the advisor as the conductor of the orchestra, but the orchestra is a whole bunch of, all the instruments are a whole bunch of different agents and a whole bunch of different, or, in the case of Vise, one fully integrated tech platform, but it's able to help run their entire business for them. So what does that advisor do? At the end of the day, they're basically directing the software in the right ways to basically solve the client's problems for them and stay on top of the client and be that translation layer between the software and the client's financial plan, the client's financial journey, and all their goals and expectations. I almost think about it as, in some sense, Vinod Khosla talks about this idea that in the future, doctors will be actors because robots will be doing all the surgeries. It's the same way with advisors, right? Great financial advisors will be great actors, and they'll be great at bedside manner and great at understanding how clients think and how to kind of manage those relationships and translate that into things that technology and problems technology can solve effectively.
Does that change the sort of expertise that an advisor actually needs to be a good advisor?
Yes. I think that it means that advisors have to lean in more into, we're going to provide great relationships and we are going to understand what makes our clients tick and how do we become a more core part of their holistic life and everything about them than just thinking about the sliver of the portfolio that they manage today.
That's super interesting. You could almost imagine a world where you don't have to study finance to become a financial advisor.
The best financial advisors will probably study psychology, or they'll be the highest EQ people, not IQ people.
I think that's probably true for a lot of success in human labor going forward, EQ over IQ. I'd love to get into the conversation around private markets. The last probably 2 or 3 years, we've seen a huge wave of interest from both the wealth channel as well as many self-directed retail investors to get access to private markets. And in the last, I would say, year or so, we've seen particular interest from the alternative asset managers in actually combining public and private markets into a single portfolio view for advisors and their clients. Where do you think that demand is coming from? And what do you see as the value of including private markets as part of a broader portfolio?
So I think the first thing here is that, to your point, everything will come together into what's referred to as a whole portfolio solution or total portfolio experience. So your platforms that used to just do public markets will have to do private markets. So Case can no longer just do private markets. They'll have to figure out how to do public markets. iCapital no longer do private markets. They'll have to do public markets. InvestNet and Orion will have to do private markets as well. It'll all come together. So you're going to see a mass convergence of all the platforms in the space to being what are referred to as whole portfolio solutions. They have to be tax aware. You have to be aware of the client's entire financial picture because alts will become a key part of the story. And I think alts specifically, originally were kind of hot around venture and SPVs and late stage private companies because so many of them weren't accessible to retail investors. But I think the predominant channel for alternatives is actually kind of semi-liquid interval funds and income type of vehicles, private credit, things like that you're seeing from the major private equity firms now looking more like public asset managers in their distribution of alts. So I think that you're going to see a convergence of all of these things. You're going to see a place in which these alternatives fit in everyone or a large portion of people's portfolios. But I think that the, hot, venture capital type investments probably don't fit in most investors' portfolios, which is where all the attention has probably gone. And I think that will be a part of a subset of portfolios. But for the vast majority, it's like, how do you actually solve the orchestration problem of fitting interval funds and private credit and other types of structures into the everyday investor's portfolio? And that requires a platform advancement more than anything else.
For sure. I agree on both points. I think the wave of demand from self-directed retail in particular has started in the pre-IPO space, and we're seeing that here at Monarch. But even within pre-IPO, you're now seeing evergreen fund product wrappers providing broader access to the pre-IPO market, whether it's a tender offer fund or an interval fund. And that's more of a diversified point of access for investors. But within the rest of private markets, I also agree. I think most advisors in particular are just looking broadly for private equity exposure, private credit exposure, infrastructure exposure to include in their portfolio. I'd like to get your point of view on the infrastructure challenges that you see from your seat at Vise to actually include evergreen funds or alternative investment products in a portfolio like Vise manages today.
This software has to be figured out first. Like, the biggest infrastructure challenge is the actual infrastructure around how do you orchestrate all of these investments today. Most of these companies, whether it be Apollo or Blackstone, have incredible sales teams. They've got great methodologies to how this fits into the portfolio. The big gap is, how do they effectively storytell? Here's how this private markets solution will fit into your broader portfolio. And in order for them to do that, they have to understand your broader portfolio, which they don't do today. They expect the advisor to understand the broader portfolio, which in most cases, the advisor doesn't understand the broader portfolio. So only software is going to be able to solve that problem. The challenge is the legacy software that most of these advisors sit on isn't aware of the client and everything going on with the client. You've got data that sits in the financial plan that doesn't talk to the order management system, the trading system, but doesn't talk to the underlying SMA managers. So you've got this entirely, unaware, unintelligent experience that surrounds the money. So in order to effectively solve the alternatives problem and where they fit into the portfolio, why, and how to effectively solve the orchestration problem, you need one platform that can effectively understand everything about the client, understand everything about the underlying investment strategies, and bring it all together in one intelligent, aware solution. The existing platforms, I have a hard time believing will get there. And part of the reason why is just because how they're built, right? Most of these platforms, whether it be an Orion or an Envestnet, were roll-ups of a whole bunch of other software. They acquired Money Guide Pro, they acquired Redtail, they acquired a whole bunch of tools that were built on different tech stacks, different rails. None of them were integrated together. So in order to solve the problem, they basically have to burn the whole thing down and start from scratch, which is a really hard thing to do when you're owned by private equity and you've got EBITDA targets and you've got a huge organization that is really hard to move.
That's a super interesting perspective. I guess, what is your answer then with Vise?
Our answer with Vise was, I'd say, twofold. The first is building it from scratch, right? Modern tech rails, build everything from scratch, all integrated as one, platform from the beginning. So you don't have a separate proposal tool from your rebalancing engine, from your SMA or your asset allocation layer. Everything is all kind of integrated from scratch day one. And the second was build a team and build a culture of engineers where they have business logic and they understand the customer's journey and they can go and solve problems in real time with each of those customers and unblock things really, really quickly, because you speed up your iteration speed at solving problems on behalf of all these advisors. So if our engineers understand, okay, well, here's the issues that our advisors are having with cash, or the issues that they're having recommending long short, or the story they're not able to tell because we don't effectively talk about how much tax loss harvesting is a benefit to clients, then we're not going to actually be able to improve the product. But because we can do that, we can improve the product much faster in real time. And you create this culture where you're innovating very quickly. And as a result of innovating very quickly, you create a better product experience that helps advisors grow faster, that helps them deliver more personalized portfolios, and helps them service more clients all in one intuitive experience.
I really like the idea that you presented of, today you have fragmented data across the different layers of the software stack for most advisors or advisory platforms. And in order to effectively tell the story of why you should be including alts as part of a broader portfolio, whether that story is being told by the alternative asset managers or by the platforms themselves, you actually do need to understand what exists in the portfolio today. I think that's very intuitive and makes a lot of sense. Maybe not something that the rest of the industry is fully understood yet, but certainly talking to a lot of the alternative asset managers from my seat, I definitely hear that a lot and see that a lot. I've also seen, and I'm curious your take on this, some of the asset managers, alternative asset managers, really starting to push into the space of actually managing the full portfolio for advisors across public and private. So not staying siloed just to the private funds that they've historically managed, but also now coming out and saying, we're gonna design what a total portfolio construction looks like, including alts, stepping into that position as opposed to just the the alts that are included in the portfolio?
The only major one that's doing that today is BlackRock. And it's a result of their HPS and GIP acquisitions. That's kind of expanded their ability to do so. The challenge that BlackRock has is they don't have a technology platform. So they don't have that experience where they've got software that can effectively kind of handle that sale. Because I think asset management is no exception to a whole bunch of other industries, right? And HR tech is a perfect example. You had ADP and you had people that were recommending benefits and helping handle and manage benefits. And now you have Rippling, right? And Rippling is fully automated. It's fully integrated. You've got everything that used to be done as services by people and processes are now being done by software. And I think that it's no exception that asset management will have the same rules. Instead of wholesalers distributing portfolios, you're going to have software distributing portfolios that are aware of everything going on in the portfolio. And I think that's the next major step that all these asset managers are going to have to shift to as this industry starts to transform.
Samir, I appreciate you coming on the Capital Connect podcast and sharing your perspective. It's been a great conversation. Thank you so much for joining us. If people are interested in finding Vise today, how can they get in contact with you or the company?
Feel free to check out our website at vise.com, vise.com, or shoot me an email, just samir@vise.com. Thank you so much for taking the time.
Absolutely. It's great to have you.